Good evening, this is John Grover. It is December 17th, 2018, and I'm doing a mid-month market update. I'm a little bit late this month, and hopefully I'll get another one done right at the beginning of the year. I sent an email to some of you last week, and we never did get above that Friday, December 7th high. Instead, the market has chosen to break down. So the most likely path for the stock market going forward is probably a bounce up and then a fall down to lower support levels. This may or may not be the beginning of the bear market that I expected, that I'm implying with this huge red arrow here. But I do believe we're going to work our way lower over the next few weeks. Indicators, however, are in a spot, as we've talked about before, where they could provide a bounce. If you look at the history here before, say in January 2016, and then I'll slide on back, basically anything below this red and green line here ultimately worked into a bounce area. Now notice how most of the bull market stays above that level. Now the danger point is when we have a bigger bear market. Notice even here it pulled back strongly and chopped around below this indicator level first, and then it finally found a way to bounce up, and this was in 2011. So not terrible pullbacks, but the danger point is that we have this fall down below. This is 2008. Notice how the indicator went below, and then it failed to rally above the indicators or the moving averages in this chart. And we got a pretty clear sell signal, especially note what happened when the indicator fails at this red line. It is what's here in the chart right here. That is where the strongest leg down began in 2008, and the bottom did not occur until this relatively bullish zone in the indicator was tested again. So just beware, or be aware, that this could be the beginning of the bear market. The indicators would fall down, and then we would begin to have a failure here at this indicator level, I believe, would be the proper signal, and that's what has tested out in the past. So just beware, even though the market's broken down and you would hate to sell low, it may be still okay to eliminate positions, especially if we get a little bit of a bounce up here. I think it's becoming less and less likely that we will see a new high as the market falls down. Let's look at the other two markets we follow real quickly. Our gold chart has shown that it's been a little stronger than expected. It hit the second resistance level that we marked last month. Note the indicator level is strongly in this spot that usually causes a pullback. Note these areas here, this area, this area, this area, this area. As you can see, it's a fairly consistent area. However, when these averages are positive, you get more failures, and these averages are positive. We're right at that point where a breakout here should at least go to this upper level of resistance, and then maybe we will begin to see if this is a bull market in gold beginning. I still think that the evidence shows that we could retest down to 1130.7 just to kind of test the bottom of this range, as we've talked about every month for the last multiple months, but this is getting strong enough where we are starting to see some evidence that maybe a new bull in gold is beginning. So just be aware of that. All right, let's look at bonds. Bonds have been also strong. They've kind of followed the same trajectory that gold has. Stronger than expected. Once again, I expected a full test down to this red line here, 127.23. But they broke out above this little consolidation area and now are looking to at least test this first 144.14 resistance. And then I expect a little bit of a pullback, once again using the indicators Here if we get to that resistance level, we're probably going to be at this red line in the indicator, and you can see that when the market gets to that level, you tend to have a little bit of a pullback at least. This green area, if we can hit that resistance level and then pull back and then hold on to some of these nicer support areas in the indicator, then I would be more comfortable talking about the bonds being a bottom. And if we have a bear market in stocks, often bonds do rally, especially in a deflationary situation. And so we could actually see a new high, which, if you could imagine that scenario where the Fed would drop interest rates below zero like some of the central banks in Europe have done, or even in Japan, we're not immune to that either, so just beware that that could happen. Thanks for watching, and stay safe and financially sound over this next few weeks, and hopefully I'll post something in the first week or two of January. And have a great holiday. Thank you.